Good afternoon, everyone, and welcome to TBR's webcast, Convergence or Anarchy. 2014 will be a decisive year in management consulting, which outlines performance, leaders, and laggards, and future trends as reported in our management consulting benchmark. I'm Allison Crawford, and I will be your host for today's webinar. Technology Business Research's sixth iteration of the management consulting benchmark analyzes changes in the market, and over the course of the next 45 minutes, we'll highlight high-level findings of this unique research, including what's affecting the market and how it will affect you. This research is available for purchase now. Before I pass this over to the analysts and the rest of the management consulting team, there are a few logistics I'd like to cover. First, we're recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A or chat function. We'll address them at the end of the presentation. Or you can request an inquiry call for additional questions. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find these slides, as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight, and we'll share all the social media links again at the end of the presentation. Now let me introduce Patrick Heffernan, Jen Hamel, and Hristov. Patrick is a State Department and Deloitte alumni and is the lead on our management consulting benchmark. Jen and Boz are research analysts focusing on the vendors as reported in the benchmark. And with that, let me pass this over to Patrick.
Excellent. Thank you, Allison. So this is the sixth one of these benchmarks, and it's the third time that I've had the pleasure of leading this webinar, and so it has given us a chance this time to really look back on what this benchmark has been saying over the last couple of years and what kind of trends we anticipate seeing going forward. I wanted to start with this particular slide because I know some folks on the line here are not entirely familiar with TBR and how we go about our analysis and our research. And so I want to make that clear at the start that everything that you see and hear in this webinar is going to be built on the analysis that we have done vendor by vendor in the management consulting space. So what TBR does is a very deep dive on the largest, the leading vendors in management consulting, in IT services, in cloud, in global delivery, and all the rest. And by taking a vendor-by-vendor approach, we end up building an understanding of the marketplace as defined by the leading vendors in that space. So we look at performance metrics, we look at strategy, we build all that up, and then we create these benchmarks. So what you're getting is a look at 16 vendors, but very much a look at the vendors themselves and then a picture of the marketplace as it comes from there. So what we're going to cover today, okay, is some evolution in some of the most important vendors. We're going to cover PwC, Booz, there we go, PwC, Booz, Accenture, and IBM and their reorganizations. We're going to look at the leaders. We're going to look at the performance metrics that we track across 2013. And let me make clear here, the benchmark we just published covers the performance metrics for 2013 and projections for 2014. So when we talk about 2014 numbers, it'll be our estimates. And then the last part, we'll look at what we do anticipate coming in this year, and we'll take a closer look at two specific regions. So PwC's acquisition of Booz, there is no way that I can possibly understate how important this acquisition was. You can see in the chart here that PwC had been slowing down in terms of year-to-year growth. They have a strong brand. They have a string of technology acquisitions, but they were sort of perpetually stuck behind Deloitte, McKinsey, and the others in the space. So with this one acquisition, PwC has cemented itself as a global strategy consulting firm, and Booz Digital provided that last piece that PwC needed in order to launch their own digital practice, which they did this spring. Booz and Company was a good cultural fit for PwC as well. As a firm, as a partnership, and a similar structure to PwC, it was an easier acquisition for PwC to make. There was also, in our analysis, a lot less geographic and even service offering overlap between the firms, and we do think that for those reasons, and it went smoothly, that it'll continue to go smoothly. Now, all that said, some questions remain. What PwC acquired was talent. So the big question remains, how much of that talent will stick around? How much of that talent is going to remain with PwC even after the terms of the acquisition go through? And then the other question is that within PwC, when the acquisition was final, they immediately rebranded essentially Booz as Strategy and. So they are the strategy consulting aspect, or the strategy consulting practice within Booz. That's fantastic, but what does it mean for all the Booz professionals, the Booz partners and consultants who are not part of Booz's strategy practice? So the question here is going to become, are those folks part of Strategy and now, or are those folks fully absorbed into PwC, and then how is that going to go forward? And we've seen other Big Four firms make these kinds of acquisitions, not on the same scale, but maintain that same branding. So it'll be curious to see how that all plays out. And of course, in the last part is, what exactly do PwC's clients now believe that PwC can deliver that they couldn't deliver before they acquired Booz? And so it'll be that permission aspect of the equation as that comes up. So that's PwC and Booz. And now I'm going to turn it over to Jen, and she's going to talk a bit about Accenture and IBM.
Thanks, Patrick. So here on this slide, we're focusing on the leaders in the management consulting benchmark. IBM and Accenture are the two biggest solutions-led players that we cover. Capgemini is also on the list. They are a small portion of revenue that we're focusing on IBM and Accenture here. So both of these vendors performed very similarly in 2013. They each declined approximately $30 million from 2012 to 2013, but grew slightly in the U.S. over the same period. So what we wanted to call out here is that each firm is taking a slightly different approach in reorganizing their structure to better serve the evolving IT and business consulting needs of their clients. So on the left here, you'll see IBM Strategy and Analytics. Earlier in 2014, IBM combined their analytics, strategy, and interactive experience consultants into one practice within GBS. So this was significant because they are delivering both strategy and technology implementation services through one practice. They organized this unit into 5 practice areas, each focused on a different C-level executive issue. So, for example, interactive experience focuses on customer experience, generally through the CMO. There's also a technology and data group that focuses on CIO. So they have a very LOB focus in their strategy and analytics group. And the idea behind this is that they lead with strategy and they follow through with the analytics, technology, implementation, and managed services. So they're appealing to not just the IT buyer, but the LOB buyer. And they're able to manage the relationship on the business side as well as the IT side. And this makes sense with IBM's overall approach because they, in general, with their services, will bundle services, software, and hardware into this cohesive business solutions. So this is just another example of them evolving their business model in that way. On the right, you'll see Accenture Strategy and Accenture Digital. They actually split their two areas into 2 different groups. The Accenture Strategy group brings together management consultants and technology consultants. They address the C-level transformation agendas, and they make recommendations to their clients. If a technology solution is called for from those recommendations, they turn the client, in some cases, over to the Accenture Digital Group, which will handle analytics, mobility, and also the interactive or digital marketing programs similar to IBM. So these 2 units, they operate independently. They can work together if the engagement calls for it, but engagements can start from either side. And this makes more sense for Accenture compared to IBM because Accenture is a systems integrator. They want to stay technology agnostic. So both of these reorganizations represent logical shifts for respective companies as they look to meet their clients' needs around IT and business transformation. They both focus on industry expertise. They focus on the C-level executives, not just the CIO, and they're evolving their technology portfolios as the needs of the business are moving in a technology direction. So if we see, if we move to slide 7, the next slide, we have been observing this trend since the 2811 iteration of the benchmark. So this is a long-term strategy that is now being implemented. But what we can see, so on the left here we have a couple of quotes from our 2811 benchmark, and it's focusing on these same themes. That they're focusing on the industry-specific solutions, looking to combine IT and business agendas. But if you look on the right, this is a pie chart from our benchmark that's showing the entire benchmark revenue and how each vendor group comprises a share of revenue. So the gray group that circles is the solutions-led players. Their share of revenue has been shrinking over time. The middle circle is 2012. The outer circle is 2013, and then 2014. So as you can see, the share of revenue from solutions-led players is shrinking, whereas Deloitte, just on its own, not to mention the Big Four, has been growing over the same period. And the reason for this is that IBM and Accenture are posted essentially flat revenue growth from 2H12 to 2H13, and they're both declined on an annual basis from 2012 to 2013. So despite all the efforts to evolve their business models and their engagement strategies for management consulting, it has not translated to increasing their share of the management consulting pie. And now I'll turn it over to Boz to go over the 2013 results from the benchmark.
Thank you, Jen. On the next couple of slides, we're going to go over the results of 2013 and some of the drivers, particularly technology as a disruptor, how it's impacting revenues, revenue share, and growth of some of the leading vendors within the benchmark. On the current slide, overall the dynamics of the management consulting landscape did not change drastically. The big vendors became bigger. The small ones shrank their revenue from management consulting perspective. Jen touched base already on IBM and Accenture going through the reorganization and trying to realign their portfolio better to compete with particularly the Big Four and the leading management consulting vendors such as McKinsey. A couple of vendors to point out here. Deloitte crossed the $10 billion mark in the revenue in terms of the revenue size, as you saw probably on the previous slide. It maintains the largest share of across the 16 vendors within the study. The reason we see Deloitte is continuously driving sales in the consulting space is really the ability to adopt and the pace of adoption of technologies within their management consulting services, as well as their appetite towards innovation and moving faster than the other vendors, and this also established their consulting brand. McKinsey's growth decelerated slightly to put to number 3 position behind the Deloitte and KPMG. The key reason we identify here is the reorganization within McKinsey's business structure, and it's not that they are challenged, it's more so they are realigning again their portfolio and implementing McKinsey solutions within their strategy consulting offerings. Accenture, as Jen mentioned, that they have been going through a major reorganization. Their revenue share shrank. Reason being is they are consulting bookings, even though they record some record consulting bookings over the second half of 2013, they've been converting at a slower pace due to elongated decision cycles along mature market clients. We saw some improvement in the first half of 2014 in Accenture's consulting bookings. Certainly something to keep an eye on before we identify as a trend. But they do have the deal pipeline ready to execute on, and with the right approach between the Accenture strategy and Accenture Digital, the growth platforms, we believe they could expand and regain their share of the loss to the Big Four. Over the next slide, we can move forward, Aslan, thank you. We're going to look at some of the drivers, particularly in technology consulting, and we chose to point out technology consulting as a driver behind it is technology has disrupted the management consulting industry. That's not something new that I'm sharing with you folks, but it's really a driver, and it's really it's forcing traditional consulting vendors as well as solution vendors to really get up to speed and also be able to instead of being to play catch up, to remain leaders and to the right solutions, the right partners, the right acquisitions, certainly strategies that all of those vendors are identifying and pursuing one or the other. Couple of key points I wanted to highlight on the chart that you see on the slide is, first of all, McKinsey's technology consulting size in terms of revenue versus Accenture's. They're relatively similar in terms of size, but if you think about it, Accenture is a solution-led vendor. And one would expect technology consulting to be much faster growth. Unfortunately, it's not the case, and I kind of pointed out some of the reasons earlier. Where you can see McKinsey is expanding at double-digit revenue growth is that ability to really add that layer of technology at a faster pace to the already established strategy consulting to gain that CAGR growth of 10% over the last 2 years. The other key point is KPMG, and I'm kind of comparing to Accenture, the size and the scale of a Big Four company versus solution-led company such as Accenture is certainly a key point to look into, and the size and also the faster growth. Reason behind the KPMG and McKinsey and just overall and Accenture, each of the companies took a different approach. KPMG certainly benefits from inorganic investments. They capitalize on their purchase of Hackett, Oracle practice of Hackett Group. Moving on with the engagement with Siemens North America on an HR development engagement. McKinsey's solution set is expanding in terms of capabilities and also inorganically. They recently purchased a SaaS vendor in Europe that allowed them to beef up their financial services consulting capabilities. And Accenture is definitely leveraging established relationships with, particularly with SAP, most recently establishing the business group that will be focusing on developing solutions towards Fortune 1000 clients with specific verticals. And like I said, each of the vendors is identifying trends. Ones are accelerating faster than others, but I believe those trends will see, some of them will continue to expand, some of them will continue to shrink in 2014. And I'll pass it over to Patrick with that.
Excellent. Thank you, Boz. Thank you, Jen. So what they just did was they laid out what the top vendors are doing in the space, what the most active and actually the largest vendors are doing. And so that allows us then to take the broader look and say what's happening in the big picture as the market as a whole. So there are 3 ideas on this slide, and as you read them, I'll start talking about them. But the key points are this. First of all, we've been talking about emerging technologies for a while, and while I think we anticipated that these technologies would have the largest impact on technology consulting, doesn't that make sense? What we're actually seeing is that, and this is reflected in what Jen talked about with IBM and Accenture and their reorganizations around strategy, is that strategy consulting is being impacted by emerging technologies in a surprising way. What we're hearing, and again, this is something that will have to be borne out over the next couple of years, is that in many ways, emerging technologies, and particularly analytics, is informing strategy in a way it hadn't before. So clients are coming to strategy consultants and saying, show me the metrics on it, show me the analytics on it, dive into our data first, and then let's talk about the strategy implications afterwards. And that's a big shift. And who I think that's going to have the largest impact on is actually not IBM or Accenture or even Deloitte, but McKinsey. And we've already seen McKinsey ahead of the curve with McKinsey Solutions. It's been out for a couple of years now. They made a couple of acquisitions. They're still in an acquiring mood. Every single time we do this webinar, there's something that makes me stumble. So, an acquiring mood apparently is hard to say. It is. So McKinsey is still making acquisitions. They aligned with Nielsen Media. That's old news. They aligned with Lufthansa. at the end of last year. The McKinsey Solutions practice, if you want to call it that, within McKinsey, I think is where we're going to see the emerging technologies have the largest impact on management consulting, and McKinsey is sort of the flagship for strategy consulting. So what they do in the strategy space is going to dictate what everybody else does. The second part on this, in terms of the offerings and the scope of management consulting, I think that's also changed. Again, this is the third webinar that I've done, the sixth iteration of this particular benchmark, and the number of services and the scope of services that are included in management consulting is creeping upwards, and it's a result of these firms doing more in the consulting space and doing more management consulting. And then finally, this idea about instability and unpredictability in the marketplace. Our benchmark had 16 vendors. It now has 15 because one of them bought one of the other ones, and that kind of disruption is going to continue. Now, I don't anticipate any of the other vendors, any of the remaining 15 being bought, although it could certainly happen. There are some that are on the smaller end of the scale. But what I think is more likely is that we'll see alliances, or we'll see some of the vendors being broken up into pieces to focus on delivering a specific kind of, whether it's emerging technologies or a specific kind of consulting. So I think over the next couple of years, we're going to continue to see this kind of disruption in the marketplace. So that's where we build up to the market level view of what's going on based on what the vendors are doing. Because the benchmark itself covers 4 different service lines, 8 different verticals, and 4 different geographies, we do want to spend a little bit of time today focusing on 2 of those regions to give you a flavor of what else is in the reporting and the analysis. So we'll go to the next slide. We're going to talk about APAC. So Asia Pacific, everything that's on the left, folks can read that. That's all the bad news that came out of Asia Pacific in 2013. It's interesting, it's good to know. What's important is what's on the right. That was a decision in May where the Chinese government announced that they were essentially kicking, the colorful way to say it is they were kicking U.S. consultants out of China. Now, that's the difference between an announcement and actually a implemented policy, or even a policy decision, is dramatically different. And the Chinese government can announce something and not actually do anything for a long time. We are seeing some signs that there's pressure on those firms, but I think the established relationships, even the established revenues that those firms are driving in China are not likely to change in the near term, but just that announcement on its own creates more risk in a market that was already beginning to get a little bit sluggish and a little bit questionable. So I think we will see a number of the firms that are active in China start to look elsewhere in the region as well. So, a couple of specifics about Asia Pacific while we're on it. IBM announced a $1.2 billion investment in cloud. Part of that is going to include new data centers in China and in Hong Kong and in Japan. Deloitte opened its 17th office in Chengdu, which I'm probably not pronouncing correctly, but in any case. And then PwC formed a joint venture that included a few of the practices in Southeast Asia, as well as New Zealand and Australia. So there's still activity going on. I don't anticipate that the numbers are going to turn dramatically in 2014, and I do think we're going to see a little bit of a pulling back, at least until the decisions from the Chinese government regarding U.S. consulting firms is made more clear, whether that was just a PR announcement, a political announcement, or actually something that will come into effect. So that's Asia Pacific. Now we look at Latin America, where the story is completely different. Here, everybody grew in 2013. Hopefully, everyone will continue to grow in 2014. Let me hit a couple of specifics real quick, and then I'll come back to what's on that slide. So Accenture made an acquisition of a company in Brazil that specializes in mortgage processing. It seems to be outside of the scope of management consulting, but it really feeds into Accenture's entire global delivery strategy. It fits into what they're doing in the region. Ernst & Young had a 24% corporate growth in Brazil for fiscal 2013. Now, the corporate growth includes stuff that's outside of the management consulting space, but again, it's indicative of the success that some companies are having there. Now, here's the question: will that growth continue, particularly if Brazil Brazil performs as badly as it did against Germany, then the whole region's in a lot of trouble. But if Brazil does start to come down, if Brazil's economy does get sluggish, they are, unfortunately for that region, a bellwether and the largest economy. And so the challenge there, the challenge there, other than the macroeconomic aspect of it, because none of these companies have the ability, even McKinsey, to dictate the macroeconomics of any country. But the challenge they're going to continue to face is one around people and permission. There is still, and we hear this repeatedly from our sources in the region, there's still a real challenge in getting the right kinds of people and getting enough talent and recruiting and retaining and training people to do the kind of work that we're talking about here. That's one challenge. The other is permission. A lot of these companies don't have that same brand recognition in Latin America that we expect them to have, or we know that they have in the U.S. and in Europe. So as the economies grow and as the opportunities for these vendors grow and as they continue to invest in this region, that brand and that permission part of it will change, but the war for talent aspect is probably going to continue to be a problem for everybody. So we'll take one last slide, I think. Yes, and so I'll turn it over to Jen to just to give you a flavor for what's coming up. And before she does, let me just explain the way this benchmark works, so it'll put her comments in context. We do the research year-round, and we publish it twice a year. We publish in June, and we publish in December. And so what you're hearing about today is the research that follows from the June edition of the benchmark. So what we're in right now, where we are in the cycle right now, is we're beginning to do the research that will feed into the December publication. So Jen?
Thanks, Patrick. So this slide shows the topics that we will be looking at for the 1H14 benchmark that we're going to be getting started on very soon, 1H14. Today. We're getting going on it. 1H14 just ended, so this is the data that we're going to be looking at is mostly in. The topics that we're focusing on, Patrick alluded to in his comments. Latin America and China are both regions that we will continue to monitor. And then the use of acquisitions, this is certainly something we've been looking at for several iterations now, and we'll continue to look at that as well. And I wanted to draw your attention to the left. In addition to the benchmark, we also publish a series of syndicated vendor reports where we dive a little deeper into some of the vendors that we cover for the management consulting benchmark and others that are we cover for their entire IT services organization. So the list of reports is there. The publishing schedule I'm not that clear on, but I'm sure if you go to the TBR website, all that information is there.
And one other thing I want to throw out there, and to anticipate maybe a question that's coming up, how are we going to reflect Booz & Company and PwC? You can see on the left on that slide that PwC is on the list of syndicated reports. That's new. We're going to publish it in, anybody remember when we said? September, I think? September. So we're going to publish a syndicated report on September. We'll do it twice a year. On PwC in September, we'll do it twice a year. For the purposes of the benchmark, the data that we showed here today all shows PwC and Booz separately, and that's because we were looking at the 2013 data. The acquisition didn't actually go final until earlier this year. So when we publish in December this next iteration of the benchmark, we're going to show two sets of numbers. We're going to show PwC with Booz together, and we're going to be able to go look back and show those two firms separately as they were historically. That will allow us to show the growth rates. It allows us to show what the firms look like. But we do want to combine them as one and show how that new entity is, where it fits relative to others in the space. So hopefully that clears up any questions about what we're going to do. And I just really hope in the next 6 months we don't have another major acquisition like that, because it's a challenge, although it's exciting. So, all right, with that, we can turn it over to questions.
Excellent. So thanks to those of you who sent questions through. We have a couple already in queue, guys. And just so that we are all aware, this webinar was 25 to 30 minutes of content on a 90-slide deck. So there's a whole lot more information there. If you have questions, please do send them through now. The first question we have everyone in queue is, has management consulting been growing faster than the economy as a whole? Is it growing industry overall, even if some vendors are struggling?
That's a tough question. It's a tough question for a couple reasons. As I also mentioned, that the benchmark itself is huge. I think I mentioned it has 4 separate service lines: strategy, operations, organization change, and technology consulting. It covers the U.S. It covers the U.S. as part of the Americas. We do metrics on, as you saw, APEC and Latin America, as well as Europe, and we've broken out Europe from the Middle East and Africa. It's 16 vendors. It is a massive product with a massive amount of data behind it. But the challenge with looking at growth is there's no really good global metric for growth. Even when you break down into the regions, if we said EMEA, I mean, everybody within Europe has got different growth rates. The best that we can do really is look at the U.S. And so we can take the U.S. and we break this out in the benchmark. We have numbers specific to data specific to the U.S. So we can look at the U.S. and we can look at U.S. GDP growth. And over the last 3 years, what we've seen is that management consulting, that these vendors in this benchmark have grown in the high single digits over the last, as a whole, over the last few years. You know, as Jen mentioned, Accenture and IBM have been basically flat. Others have been growing much faster. But the management consulting benchmark vendors' revenues as a whole have grown in the high single digits at the same time that the U.S. economy has grown in the low to single digits to almost flat. So at least within the U.S., management consulting has been outperforming the economy. But again, that varies from vendor to vendor as well. Hopefully that answered the question.
We've actually had a couple of questions come in that are vendor specific, and I know listening to you guys talk about them, there's going to be a lot of disagreement on this. The next question we have is, what can stop Deloitte? Are the Big Four going to outperform IBM indefinitely? Who wants that?
I'll take the first shot at that. Okay. So I know that my colleague Boz and I disagree on this point, but the way I see the trend going is, as Patrick was speaking about earlier, as analytics are integrated more into business decision making, the technology innovation is, I feel, going to become more important than the bodies on the ground consulting. So whereas Deloitte now is, you know, they have a partnership model. We're seeing challenges to this type of business model in the legal industry. I don't think that the consulting industry is excluded from that. So as business decisions begin to be informed more by data than by MBAs, we'll see IBM, which has established investments in this area. They have a $6 billion R&D budget. They have Watson that they're starting to integrate into engagements all over the place. I see that as being a real threat to Deloitte in the long term.
It's a good point, Jen. I partially disagree with you. I mean, from a person who follows Deloitte pretty closely and the management consulting industry and the other Big Four companies here in TBR, yes, technology is certainly disrupting. We see that in many different levels. However, consulting is consulting, and as we saw from the deck we just went through, from the scale and the size and the growth of KPMG versus Accenture, does not take time for any solution-led vendor to catch up or erode the market share of any of the Big Fours, because it's easier to add a layer of technology, but it's harder to establish a consulting brand. And those folks have been doing it for 100+ years, most of them, around the consulting practice, while technology is evolving in a faster pace over the last decade or so. It's certainly their consultants are smart enough to figure this out. They can see those trends and they can buy in. They have the deep pockets to purchase the capabilities that they're missing. So they may challenge it, but I don't believe they will erode their share as much as one would expect.
Yeah, it's good answers, and I'm glad we disagree on that. I mean, no, I'm glad there is disagreement on that. Makes it more interesting.
You want to weigh in on that? Are you good?
No, I'm going to stay agnostic.
All right. Well, I'm sure you have something to the next question we've got in. Will you write the Accenture, Boz?
I do, yeah.
All right, so this one probably goes to you. I believe your latest reports on Accenture showed a healthy increase in revenue for 2014. How does this reconcile with your comments that the segment is challenged?
I'm going to go first.
You do?
Yep. So it's a great point. So for at least a year now, I have been arguing that Accenture and IBM are poised for growth and are going to grow faster than their competitors in this space, and so far I've been wrong the whole time. I think when I look back to the analysis we did a year ago, I think what was driving that was our own understanding of how much they had been able to embed and roll out and assimilate, I don't know all the words for it, but basically take all the emerging technologies and take all the acquisitions that they had made and make sense of them and roll them out and turn them into actual offerings and revenue streams and the rest. I think we understood that and we appreciated that. What we didn't understand and appreciate as fully is the need for IBM and Accenture, and we'll talk about Accenture just itself, to structure their offerings, to reorganize around this idea of strategy that will allow them to grow in this particular space, in management consulting in particular. And I think with what Jem went through earlier about how they have created Accenture Strategy and Accenture Digital, that's sort of the firm line that we needed. That's the starting point. I think now we're going to see that that growth that in the report, Boz can talk about exactly what was behind that, but where we see that growth coming from. I think within the management consulting space in particular, I know I'm going to be right this time a year from now when we see Accenture's numbers are higher, because I think they finally made that right reorganization strategic step they needed to make. Boz?
I don't disagree with that particular statement on your last thing specifically. I mean, if they're not, then they're in bigger trouble, because they do have a healthy pipeline of consulting bookings. It's just a matter of the pace of converting those bookings to cash. Yes, they did see some traction this quarter, but I would hold my horses before I say that's a trend, because we need to see at least 2-3 quarters to sustain at least mid to upper single-digit growth in the segment, considering that the IT services market is barely expanding at about 1–1.5%. So just kind of thinking about the trends where what's going on with the overall market and how it's impacting Accenture, playing that space in the size and the scale of Accenture, and it's impacting the consulting segment specifically. So as I said, I mean, they did those reorganizations around their strategy and digital, but it's certainly moving in the right direction. They're certainly looking to differentiate their offerings and the go-to-market. And we could see, but like I said, I wouldn't make a bold statement yet they'll expand a double-digit growth yet.
Okay. We had a follow-on question come on to this, guys. How would you compare the market credibility of Accenture versus IBM to capture this combination of strategy and analytics?
So we happen to pull exactly the right two analysts into the room for this, because Boz covers Accenture and Jen covers IBM, so that means I'll start off. Yeah, neither one of them are McKinsey. Neither one of them just bought Booz and Company, which provided a immediate burst of credibility in terms of strategy. But the question isn't whether or not they have the strategy consulting capabilities or even the permission. It's whether or not they can combine that with what else they bring to the table, because they're not ever going to be McKinsey and they're not going to be Booz and Company. And I do think in the discussions we've had with Accenture and with IBM both over the last 3–4 months, it has been impressive to hear the commitment. Of course they're committed to it, but the level of detail to which they have gone through to plan out how they're going to roll out both their two different approaches on strategy and analytics. They're going to continually be challenged because they aren't McKinsey, but they are IBM and they are Accenture, and that what they bring to the table in terms of analytics and in terms of all the emerging technologies and in terms of a consulting history that goes back for, well, in IBM's case, it is over 100 years, right? So yeah, So I'm not sure I answered the question. Let me turn it over to you too. No, I talk. I'm not sure I said anything.
I'll follow up on that. I mean, in terms of, I'll speak from Accenture perspective and probably Jen can weigh on IBM specifically. The way I see it is in impacting Accenture's go-to-market is it's really going to be dictated, has always been probably by the client. So we can see scaling up market share and growth, obviously through in the U.S. first as the most developed, and then Central and Continental Europe, unless another wave of macroeconomic disruption creates headwinds. What I think it is really the client perceiving the digitization of the service delivery and analytics as a way of running business rather than being a part of their discretionary spending. It's really part of their overall budget, not just discretionary budget. That would really create more opportunities, and having the right capability set will enable Accenture to really expand that share and faster than anyone else because they do have the right set tool. Jen, do you have anything to say on IBM?
Yeah, so I think, going into IBM a little bit more deeply versus what I touched on in the slides. So the strategy and analytics practice, as I mentioned before, is structured in 5 separate segments, and they're really focusing specifically on not just industries, not just healthcare. They're focusing on, well, what is the biggest business challenge of the CMO in healthcare? What is the biggest challenge for the CFO? They have very different roles, very different priorities, and I think what strategy and analytics is aiming to do is target those C-level issues specifically, and they're bringing the power of their analytics behind it to be able to demonstrate how certain business decisions or agendas can meet those outcomes. So I think for IBM, I wouldn't want to say one or the other is going to succeed, but I think IBM has a pretty strong, technology background, obviously, and with global business services, they have a pretty established reputation there. So it's just really bringing those resources together in a more of a cohesive way that I think they're pretty well positioned.
Yeah, and just to wrap it all up, one of the things that we talked about earlier was this idea that clients are looking for analytics as the beginning of the strategy consulting discussion. So rather than tablets that come down from the mountaintop, here's our 5-year plan. Instead, it's let's look at 5 years worth of data and what does that tell us about what our strategy ought to be, and then go from there. So if that's the shift that clients are making, that plays perfectly into IBM and Accenture's strengths. So is the market credibility going to change? I think it probably will.
So it looks like we don't have any other questions in queue, so I'll talk slow for the next 15 seconds in case anyone wants to type one in before I move us all along. So with that, I'm going to thank everyone for joining us today. As promised, I'm sharing with you all the social media links. Jen apparently is going to be in red today. Didn't see that coming. I do encourage everyone to follow all 3 analysts as well as TBR on the Twitter handles listed here, as well as joining our social media conversations on SlideShare, YouTube, and LinkedIn. We are sending out a lot of our research through those channels, and so that's a good way for you guys to not get emails from us. You can get all our stuff on those social media channels. As you're leaving the webinar, there's a brief survey. It's 3 questions. How valuable was the webinar? How good were the presenters? And if there's any other open-ended feedback you'd like to give us, whether you'd like to see more in-depth coverage of certain topics, if you'd like a follow-up, what have you, please do send them through now. We do actually look at these results and use analytics to change our performance from quarter to quarter, so we're bringing you more value in these sessions. So your feedback is greatly appreciated. I'm going to leave the chat function open for another couple of minutes in case there's any last-minute questions or requests to get either the report or information or last-minute comments you want to say, how great Jen did or how handsome Patrick looks today, any of that. You can just send that through now. And we look forward to speaking with you all again in another 6 months. And as the analyst said, we are publishing some stuff on some of these management consulting companies with PwC in September. So keep your eyes peeled for that, and if you need any other questions answered, please feel free to reach out to any one of us. So thanks, everyone, and have a great afternoon.